Hello, I'm Emily Montgomery. Welcome to our July Investment Outlook webcast. I'm very pleased to say that joining us today is our report author and Fidelity Investment Director, Tom Stevenson. Hello, Tom.
Hi, Emily.
Now, this is yet again an Outlook webcast with a difference in light of the current situation. We still haven't got access to the Fidelity studios, so Tom and I are both coming to you directly from our own home studios, I suppose you'd call them. Now, Tom, we've been dealing with extraordinary events and living in highly uncertain times for a while, it feels. Now, even before the pandemic, Brexit and so on had already taken us into uncharted waters. So uncertainty seems, to an extent, has been a theme in these webcasts for some time now, although I think it's fair to say none more so than now. But you look 12 months ahead in your quarterly outlook. How difficult a task is that in the current climate?
It is quite difficult at the moment. I mean, as you say, these are particularly uncertain times. But do you know what? I think it's always pretty uncertain times. You know, when you're going through it in real time, it never seems simple. The outlook always seems a bit cloudy, and frankly, that's how it feels at the moment. But you know what? It feels a bit better than it did 3 months ago when we were right in the thick of the pandemic. We seem to have settled down a little bit, albeit that the outlook is still not clear.
That's absolutely true. Now, a quick reminder that these are Tom's views that we'll be hearing, Tom's views of the market. So it isn't investment advice and should be taken as guidance only. Now, we're about to hear Tom's analysis of the global markets and the key asset classes over the next 12 months. But this is also, of course, an opportunity for you to ask questions. Now, we aren't taking questions live during this webcast, but we did ask you to submit your questions in advance, and I'm pleased to see that so many of you did. Perhaps not surprisingly, given the many still unanswered questions that the current situation seems to throw up on a daily basis. Now, just before we get to those questions, let's take a listen to Tom's views on the current outlook for investors.
Well, there's no question about what the dominant story of the second quarter was. Fortunately, in much of the world, the pandemic peaked and the curve flattened. Not so, unfortunately, in the Americas, where the US, Brazil and now Mexico are struggling to contain COVID-19. The chart here shows the pickup in new infections in the US, and if anything, things have got worse since I gathered this data. Well, what does this all mean for investors? The cost of protecting both the most vulnerable people and the ability of health services to cope with the outbreak has, as we know, been enormous. Shutting down whole economies, confining people to their homes and closing non-essential shops has seen activity tumble. This is the UK experience, with the size of the economy 25% lower in May than in February. What's been remarkable about the past 3 months, however, is the sanguine response of most stock markets. This is the US from the peak, comparing the V-shaped recovery with what happened during the financial crisis. Quite different. Wall Street initially led the charge, less so recently, thanks to its exposure to the sectors that are most likely to emerge unscathed or even in better shape post-pandemic. The tech-heavy Nasdaq is hitting new highs. So that's where we are. The more important question is, where do we go next? Investors were initially hoping for a V-shaped recovery, but few economists shared that expectation. The bath-shaped recovery, more of a U, has been the central case for most market watchers, with the L-shaped non-recovery a non-trivial tail risk that leaves us with permanent scarring to both economy and probably stock markets. My view is that the swoosh or Z or W-shaped variance is the most likely outcome. A series of recoveries, false starts and setbacks before we finally pull out of this dreadful period. It's worth pointing out, though, that our worst fears are just as often as wide of the mark as our greatest hopes. The reality is often not as bad as we think it's going to be. This chart shows the number of passengers taking domestic flights in the US over the past 25 years or so. You can see the obvious impact of the 9/11 attacks, but also how quickly things got back to normal and growth resumed. Obviously, the impact of the lockdown has been even more dramatic, but the future is just as uncertain and may turn out better than we fear. Now, let me just pause here to update on the 4 fund recommendations I made at the beginning of the year. It's a great illustration of the importance of staying calm in moments of market turmoil and sticking with your plan. The 2 more defensive fund picks this year The global dividend and the Select 50 Balance Fund have pretty much regained all the losses from February and March. There's still some work to do on the Lion Trust UK Growth Fund and the Artemis Global Emerging Markets Fund, but in both cases they are running ahead of their respective benchmarks, so I'm relaxed about the quality of the funds. Of course, sticking with it through the ups and downs of the market is something we all have to do. I'm delighted, therefore, that the evidence from a recent investor survey we conducted suggested that most of you are indeed keeping calm and carrying on. This chart here shows the responses to a question asking what people had actually done with their investments in recent weeks. As you can see, the overwhelming majority had either rejigged their asset allocation, invested more, or even better, done nothing at all. Often the best way, and certainly so this time around. Okay, let's get into the guts of the outlook then, starting with the main asset classes. Here you can see the rebound. It's been one of the strongest quarters ever as shares rode the elevator down and climbed back up the stairs. All this despite continuing poor news on both the economic and medical fronts. The reason is simple, one word: stimulus. The authorities have thrown everything at the pandemic, and investors are anticipating that, as after the financial crisis, much of the liquidity will find its way not into the real economy but into asset prices. This has left markets pricey when compared with the still highly uncertain outlook, and it's time to tread much more carefully than 3 months ago. It's not just stock markets which have recovered strongly. Here you can see the total returns from investment grade corporate bonds. For fixed income investors too, it's been a good quarter as the spreads between corporate bond yields and those on safe government bonds have narrowed. While yields are tighter than they were, there's still the potential for the reference yields on government bonds to remain steady or even fall lower. So ahead of expected volatility to come, there's still a place for bonds in a balanced portfolio. Another asset class that retains some attraction in an uncertain market is real estate. Again, there's plenty to worry about here, with retail and office property in particular vulnerable to the economic challenges created by the pandemic. But with the income streams from both shares and bonds under pressure, property remains one of the few places that investors can find a reliable yield. Also worth a look is gold, which is ticking all the boxes at the moment. The outlook is uncertain, tick. Investors are worried about a return of inflation at some point, tick. And interest rates are low, so the lack of income from gold is less of a concern, tick again. The other main commodity we track, oil, is less interesting as the market remains oversupplied, but the poorer fundamentals are pretty well reflected in today's depressed oil price. Okay, let's take a look at the main stock market regions now, starting with the UK. Our domestic market has been a notable laggard during the recovery since March. That's not altogether surprising given the exposure of the FTSE 100 to the less favoured sectors like energy and financials. Brexit has hung like a dark cloud over markets too this spring as the clock ticks down on the transition period. The UK's big attraction in the past, its dividend yield, has also fallen victim to the pandemic, so there's less reason to look beyond the problems. Still, there's a price for everything, and more than 15% down year to date, the bad news is probably factored in now. Over the pond, it's been a very different story. The weighting towards technology and healthcare has been a big positive and has helped investors look through the very obvious challenges as COVID-19 continues to spread like wildfire in southern and western states. The other big question mark over the US market this year is, of course, the presidential election in November. With the polls pointing to Donald Trump's departure, all eyes are on what a Biden presidency might look like. Less chaotic probably, but also possibly less business and market friendly. That's a worrying backdrop for the world's most highly rated market. Japan has had a good pandemic, but it already had problems before coronavirus arrived on the scene. Raising its consumption tax in October dealt the economy a blow at the end of last year, so the slowdown at the start of this has pushed the country into a technical recession that will only get worse in the second quarter. Japan is dependent on the health of the global economy as a major exporter of capital goods. The Asian side of that equation looks okay, the American one less so. Having clawed back most of the Tokyo market's losses in the spring, that makes Japan look fully valued for now. More attractive is Europe, although its markets too have bounced back strongly. There seems more justification for the rally on the continent, however, with the ECB firmly behind the region, ensuring that it will emerge in decent shape despite the short-term economic challenges. Europe is a good hunting ground for diverse revenue streams from defensive and high-quality global companies. Valuations are also more reasonable than in the US, and the better performing companies with strong environmental, social and governance ratings are in abundance here. Which leaves the region that went into the pandemic first and has emerged first too, Asia. Now, there's a real divide between the more affluent north of the region, where the authorities took COVID-19 seriously and clamped down on it in good time, and the less well-favoured south, where India, for example, is struggling to contain the outbreak. As this chart shows, the bounce back has been a very narrow V indeed for China's manufacturing sector. The question is now not so much about supply as demand. The factories are humming, but will consumers want to buy what they are churning out? That is the big question for the second half of 2020.
Okay, so let's get started with the questions. Tom, are you ready?
I am.
Right, so the first question is, a lot of questions here about the COVID outbreak. So got a question here saying, if we do get a second spike in the COVID outbreak, will there be immediately a second trough or second reaction in the stock market?
Well, okay, that's an interesting question. I mean, there are so many different influences on the stock market at the moment. One is clearly the medical aspect. If we do get an upsurge in infections, that's clearly going to be bad news. And look around the world. In the US, we're seeing particularly a big uptick in infections and hospitalizations. So I think investors are beginning to worry about that. But I think the second key point is not the medical aspect of it. The second key point is the economic side of the equation. And arguably that's almost more important for the stock market. So if we don't get the recovery in economic activity that the market is pricing in and that everyone hopes for, then I think that probably does make the market vulnerable at its current relatively elevated levels.
Okay, another question just on that. If we do go into a second spike, how long could we expect the after effects of that to last for on the stock market?
Well, I mean, the really sort of unusual thing about this, because this is a new disease, we just don't know enough about it to really judge what's going to happen. So, we're basing our estimations on previous outbreaks. Whether you go back to 100 years to the Spanish flu, or whether you go back more recently to the SARS, and of course they're all subtly different. We don't know whether this is going to be something that clears itself up in the next year or so and there'll be a vaccine, or whether this is something that we've just got to live with and it becomes almost like a chronic thing that is part of the landscape, the medical and the economic landscape for several years to come. Unfortunately, we just don't know.
Okay, more questions here on the coronavirus as well. Now, we've obviously seen the markets have reacted quite interestingly. They haven't perhaps reacted as we would have expected. They've been quite bullish in spite of the impact on the economy and obviously on the sort of the health of people all over the world. Question here, has the market, do you think, Tom, detached too much from the real economy? And is it in danger of ending up in a bubble type phase?
Yeah, I mean, there are three things going on at the moment. There's the medical situation, there is the economic situation, and there is the market situation. And you're absolutely right to highlight that the medical news is not good. It's improved a lot in Asia and Europe. It still looks pretty bad in the Americas. The economic situation is obviously behind that. In Asia, we're beginning to come out of it quite quickly. We saw in my comments earlier on this sort of this very sharp V-shaped recovery in factory output in China, for example. So that's good news. In Europe, we're nowhere near there yet. And indeed, just today, we saw GDP figures in the UK. The recovery in May was a lot lower than people expected. You can open the shops, you can open the restaurants, but if people don't want to go to them, then the recovery might be slower. And then the market reaction, the V-shaped market recovery in the end of March and through April and May was really extraordinary. I don't think anyone expected that. And it's taken us to a level at which I do think that the market is a bit vulnerable to bad medical news, bad economic news. Hopefully I'm wrong. Hopefully things turn out a bit better. But I think the market is pricing in pretty much, perfection in a way, a strong recovery.
Another big question mark, of course, over all this is the cost of it. So I've got a question here saying, with the UK and the US governments propping up their economies due to COVID-19 in order to recoup the cost of the pandemic, how severe could the recession be for both countries? Or is there even a possibility of avoiding a recession? What are your views on that, Tom?
Well, I think those are two different questions, actually. I mean, I think that the extraordinary measures which governments have taken to counter the economic slowdown, I think actually is good news for the economy and is ultimately good news for the market. I mean, if you want to see why the market has recovered as sharply as it has, it is that word stimulus. The authorities have thrown everything, including the kitchen sink, at this situation, and I think that's a positive. But the second part of the question about recession, I absolutely, do not think that we're going to avoid a very severe recession. Certainly in Europe and in America, and indeed even in Asia, we've seen that Japan is in a technical recession now as well. So we are heading into a recession. The market is looking through that recession to the recovery next year. That's what markets do. They look forward. So hopefully the market has got it right, and there will be a very strong recovery next year. But in the short term, this year, it's going to be difficult.
Okay. Now, Tom's tips are always hugely successful and very closely followed by Fidelity and other investors. Have your tips changed at all? Is the question here, because it was a very different time at the start of 2020 when you picked these. Have your 3 tips for the year changed? Are they still a good recommendation, or have you now thought of other better suggestions as a result of the lockdown time in the market?
Yeah, I mean, that's an interesting question. I think, had I had a crystal ball at the beginning of the year, then I might not have gone with exactly the funds that I did. However, having said that, I was quite cautious at the beginning of the year. The markets had gone up a lot in 2019, so therefore I was erring on the side of caution. And 2 of the recommendations, both actually Fidelity funds, as it happens, the Global Dividend Fund and the Select 50 Balance Fund, were, I picked them because I was cautious, and they have actually both recovered very well, and they're pretty much where they started the year. So I'm pretty happy with those. The other 2 recommendations, the Lion Trust UK Growth Fund and the Artemis Global Emerging Markets Funds, now they have suffered more, and that's not surprising when you think what's happened to emerging markets. That's obviously, in places like Brazil, Mexico, that's absolutely at the epicenter of the medical crisis at the moment. And the UK has underperformed other markets in the recovery, largely to do, I think, with, partly we've not had a great pandemic. I don't think we've handled it brilliantly, but I think the other big issue, of course, is Brexit, which has hung over the UK market this year. We're going through this transition period. So, but in both cases, the Lion Trust Fund and the Artemis Fund, they have outperformed their respective indices. So I think they're good quality funds. So I'm very happy with the recommendations I've made, and I'm sticking with them. But, given how the pandemic has unfolded and how technology has done so well, for example, then I would have probably gone for a slightly more techie feel to the recommendations had I had a crystal ball, which of course we don't.
Unfortunately not. Now, you mentioned in passing Brexit there, and it's very easy, I think, to forget that there are other things apart from pandemics affecting the markets and investors' decisions. Now, one big looming event is, of course, the US presidential election. A lot of questions here on, Tom, what's your view on how does a Biden presidency differ potentially from a Trump one, which is more market friendly, Trump or Biden?
Well, they clearly would be very, very different. You know, I mean, if you look at the Trump presidency, you know, there's good and bad. There are pros and cons. I mean, clearly, you know, it's a completely chaotic situation in the White House, and it has been for the duration of the 3.5 years that Donald Trump has been president. But he's taken a number of measures which have been market friendly in terms of deregulation, and in particular in terms of the tax cuts, both corporate tax cuts and individual tax cuts, which he enacted in 2017. Now, if Biden is to win in November, and that's the way that the opinion polls are pointing at the moment, then he leans to the left. He's probably further to the left, say, than Obama was even. So, you know, as Democrat presidents go, he would be a reasonably left-wing version of that. And he's made it clear that he will roll back some of those tax cuts. So the corporate tax cut, which went from 35% down to 21%, probably going to go back to about 28%. So he's going to recall about half of that tax cut. There'll be higher taxes for individuals. There'll be a higher minimum wage, and that's going to impact a number of businesses which have large workforces of relatively lowly paid workers. The minimum wage in the US is staggeringly low. I mean, it's $7.25 or $7.50, something like that. I mean, and it has been for the last 13 years. It hasn't moved at all. So that's going to change. But on the other hand, on the positive side, you know, clearly, you know, he's a more steady personality than Donald Trump. So I think, you know, what we lose on the market facing measures, I think we'll gain a bit on the steadiness, but also the investment in things like the environment, infrastructure. All of these things are actually positives for the market as well. So it's a mixed bag.
Okay. Right, then staying in the US then, of course the technology sector there has been really leading the way, and tech funds in particular have performed particularly well, quite spectacularly. How likely is this to continue?
Well, again, it's related to the presidential election, of course, because I think that you know, the tech funds have been supported by the Trump presidency. I think the Democrats are more concerned with some of the social issues and the governance issues, and not so much Biden, but remember Elizabeth Warren, who was a presidential candidate. You know, she was very keen on really taking the tech companies to task and even breaking them up. So I think that the regulatory environment will become tougher for the technology stocks, and they have gone a very long way. But on the other hand, you know, it's quite clear that our lives have changed out of all recognition. They're much more dependent on technology than they were. And I think that those big tech stocks are going to become, you know, such an important part of our lives that, you know, I wouldn't want to bet against them, you know, being extremely profitable in the future.
Now, of course, it's been a very tricky time for anyone approaching retirement in particular as to whether it's a good time to do it and what to do. So a lot of questions here around timing of portfolios and how to manage them. One here in particular, Tom, do you think it's too risky for someone approaching 60 to stay invested in the stock market in view of the current global situation?
Well, I mean, depends on your time scale, really. I mean, you know, I think in the short term, we should expect some volatility in the markets because of the uncertain backdrop. But if you're only 60, you know, hopefully you've got a long retirement ahead of you. You know, it might be 25, 30 years even. And that is a long time in the markets. And it's a long time, for example, for inflation to get to work on your more safety conscious investments, your cash and your bonds and those kinds of things. So I would say that anyone investing over a 25-year timescale needs to bear that in mind. And actually, history suggests, and of course, history is no guarantee, but history does suggest that over the long run, the stock market has delivered and will probably continue to deliver better returns than apparently safer investments. So I would be very cautious about withdrawing too far from the stock market on that timescale.
Okay. Now, obviously, in times like this, when there's lots of uncertainty, people are often looking for perceived safe havens, and gold is obviously traditionally one of those. We've seen the price rising quite considerably, and there's now talk of maybe it's slightly getting too overpriced. So the question I've got here is, with the uncertainty, is gold still considered a good buy? And if you think it is, how much gold should you have in your portfolio right now?
Well, I mean, gold has done extremely well over the last couple of years, and it's almost like a perfect storm for gold, really. There's lots of uncertainty. People treat gold as a safe haven in uncertain times. There is a bit of a residual fear of inflation coming back at some point. Gold is traditionally a decent hedge against inflation, and interest rates are at rock bottom and likely to remain so. And that's good news for gold, because gold, of course, doesn't pay any income, and the opportunity cost of that is reduced when interest rates are very low. So tick tick tick, gold looks attractive at the moment, but it has gone a long way. It's not far away from the $1,900 an ounce that it reached back in 2011. So I would keep some gold. I would invest in gold through the gold miners. If the gold price is strong, then they will perform proportionately even better than the price of the metal itself. So on our Select 50, we have what used to be called the Investec Global Gold Fund. It's now called the 91 Global Gold Fund. That's done very well. That would be my favoured way of playing the gold price. I would have some gold, but it was always going to be a small part of a portfolio. I mean, certainly no more than 10%, I would say.
Okay, now let's bring this back closer to home slightly, and the B word, Brexit, rears its head again. I've got a question here for you, Tom. UK trusts in my portfolio have not recovered, yet global, US, Far East, and even Europe have done a lot better. Is it Brexit still causing problems?
Well, it's two things. Yes, it is Brexit, and there's not a lot we can do about that. We are going through this negotiation. We're going through this 11-month transition period, and we are heading towards the end of the year is now only 5 months away, and it does look possible that we are going to have some kind of a hard Brexit. Now, combine the hard Brexit with the economic problems caused by COVID-19, that's not a great situation for the UK. So that's one reason why the UK has performed badly. The other reason, though, is just it's about the composition of the UK market. The UK is quite heavily exposed to sectors like the financials and energy stocks, both of which have done badly this year. And if you compare that with the US, which is so heavily exposed to sectors like technology and healthcare, which have done well, then that kind of explains the divergence of the two markets as well.
Okay, now they've got time for one last question. Tom, do you think value investing will see a resurgence as opposed to growth investing?
Well, the problem with value investing is it's very lumpy, and unpredictable. So value investing will underperform growth stocks for long periods of time, and then suddenly will do really well. It's a bit like gold in that respect. Gold goes nowhere and then suddenly has a really good year, like it's just had. Value investing is the same, but in order for value stocks, which just to explain, value stocks are undervalued, out of favour shares. They will tend to do relatively well when the economy is recovering strongly. I don't think we have that situation at the moment. At the moment, the greater fear is a lack of growth, a lack of economic activity. And in that environment, companies which can consistently and reliably deliver earnings growth are going to remain in favor. So I think at the moment, growth would be my preferred investment style. But when it comes, when the rotation into value happens, it will happen very quickly. So, if you have some value stocks or value funds in your portfolio, I would certainly hold on to them for now.
Okay, Tom, as always, thank you so much. Thank you for all those fantastic insights. And indeed, thank you as well to you for joining us today. It was certainly another packed out Outlook webcast. And I hope you've actually managed to answer some of your questions. If we didn't get round to actually answering yours, then I'm very pleased to say we've also got a very special edition of the Money Talk radio podcast hosted by Ed Monk. Now, Tom will be joining him straight after this webcast, in fact, to talk through any of the questions we haven't had time to go through just now. And you can listen to that on iTunes or wherever you usually get your podcasts. A full copy of Tom's investment outlook is also available to download here at fidelity.co.uk. Thank you so much for watching. Do join us again next time. In the meantime, goodbye.